Why is the world's largest silver depository, the COMEX, being drained at a record-breaking pace while the price on your screen barely moves? Is the data lying to us, or is there a hidden hand desperately suppressing prices to grab the last remaining ounces for themselves? Today, we are stripping away the illusions. We're going to expose the brutal truth behind paper silver and explain why the real signal for your financial future isn't found on a price ticker, but inside the vaults that are quickly running dry. Look, most investors are staring at the daily charts, panicking over a 50-cent drop. They see volatility. I see a massive disconnect between supply and reality. We are currently witnessing a historic exodus of physical metal, over 200 million ounces net withdrawn in just the last 8 months. To put that in perspective, that's a steeper drawdown than anything we've seen in the last 50 years of COMEX history. But here's the kicker. Despite this unprecedented shortage, the spot price stays pinned down. It feels like a trap, doesn't it? Like you're being gaslit by the market. Well, you're not crazy, you're just looking at the wrong map. In this video, I'm going to show you exactly how the paper matrix works to keep you in the dark, and more importantly, how to spot the breakpoint before the rest of the crowd realizes the vault is empty. Stick around, because once this gap closes, there won't be a second chance to get in at these levels. Let's dive into the data. To understand why this contradiction exists, we first need to look at exactly where the physical silver is vanishing. Take a look at this warehouse chart. This isn't just a minor dip or a seasonal fluctuation. We are looking at the COMEX depository, the heart of the global silver trade, and it is bleeding out. Since the middle of 2025, we've seen a net withdrawal of approximately 200 million ounces. Let that number sink in for a moment. 200 million ounces. To give you some perspective, for the vast majority of the COMEX's 50 years history, they didn't even hold 200 million ounces in total. We have lost more silver in the last 8 months than the entire vault used to contain for decades. The steepness of this downward slope is unprecedented. It is sharper, faster, and more aggressive than any drawdown in modern financial history. But here is where most people get it wrong. They look at the total inventory and think, hey, there's still silver left, what's the big deal? That is a dangerous assumption. In the world of COMEX, not all silver is created equal. You have to distinguish between two very different categories, eligible and registered. This is where the real alarm is muffled, and it's where the smart money is focused, while retail investors are distracted by the price ticker. Eligible silver is simply silver that is sitting in the vault. It meets the requirements of the exchange, but it belongs to someone else, institutions, private investors, or banks. It's just being stored there. It is not for sale. Registered silver, however, is the only silver that is actually available to deliver to settle those paper contracts we see trading on the exchange. This is the liquidity of the market. And guess what? The registered category is where the true carnage is happening. When you strip away the eligible silver that isn't even on the market, you realize that the actual buffer, the silver that keeps the global trading machine running, is at red line levels. We are seeing a massive migration of silver from registered to eligible and then right out the door. People aren't just trading silver anymore. They are taking possession. They are removing it from the system entirely. Think about the logic here. Why would major players be withdrawing millions of ounces at a record pace if the supply was fine? Why pay the massive costs of armored transport, insurance, and private storage if you could just leave it in the COMEX vaults? The answer is simple. Trust is evaporating. Large buyers are looking at the same data we are, and they've decided they'd rather have the metal in their own hands than a promise from a warehouse. If this current pace of withdrawals continues, we're looking at a mathematical dead end in about 13 months. By the middle of 2027, the vaults could be functionally empty. This isn't a conspiracy theory, it's simple subtraction.
You cannot withdraw 200 million ounces every few months indefinitely when the production from mines is already in a structural deficit. So we have a record-breaking physical shortage. We have a drawdown steeper than the 1970s bull market. We have industrial demand for AI and green tech hitting all-time highs. By every law of economics, the price should be screaming higher, but it's not. It's hovering around $80, looking sluggish, looking bored. This brings us to the billion-dollar question. If the physical vaults are nearly empty, why hasn't the price exploded yet? To find that answer, we have to leave the physical vaults and enter a digital hall of mirrors. Because while the physical silver is disappearing, there is another type of silver that is being created out of thin air to keep the illusion alive. I'm talking about the paper matrix, and in the next section, we're going to expose the weapons the big banks use to keep the price pinned down while they scramble for the remaining physical bars. Stay with me, because once this gap closes, there won't be a second chance to get in at these levels. But if silver is so scarce, if the vaults are literally bleeding out, why hasn't the price exploded?
It feels like gravity is broken. The answer lies in a financial hall of mirrors called the paper silver market, a place where people sell things they don't own to manipulate the price of things you see. Think of it this way. For every single ounce of real physical silver sitting in a vault, there are hundreds of ounces of paper silver being traded on digital exchanges. We are talking about a leverage ratio that is absolutely staggering. At times, the paper market is over 100 times larger than the physical market. Imagine a stadium with 100,000 tickets sold, but only 1,000 seats actually exist. As long as nobody actually tries to sit down, the game continues. This is the paper matrix. So, who is controlling this matrix? To find out, we have to look at the COT, the Commitment of Traders report. This is the confession sheet of the big players. When you dig into the data, you'll notice a recurring pattern involving the bullion banks, the massive institutional market makers. These banks hold short positions that are often larger than the total annual production of the world's silver mines. Now, why would a bank sell that much silver? Are they bearish? Not necessarily. They are managing the price. Whenever physical demand starts to pull the price higher, these institutions can simply click a button and flood the market with digital silver contracts. By dumping thousands of sell orders into the market in a matter of seconds, often during low volume hours like the Asian Open or London pre-market, they trigger a waterfall effect. They set off the stop losses of retail traders, create a panic, and force the price back down. It's a classic liquidity hunt. They aren't selling silver, they're selling fear. This manipulation serves a very specific purpose. It keeps the spot price low, which discourages you from buying physical metal while allowing industrial giants and smart money institutions to keep scooping up the remaining physical bars at a discount. It's a wealth transfer hidden in plain sight. But here's the twist. This strategy only works as long as the people holding the tickets don't ask for their seats. As we saw in the previous section, the COMEX registered stocks are plummeting. This means more and more people are starting to sit down. They're demanding physical delivery. They're taking their bars out of the system. The bullion banks are playing a dangerous game of musical chairs. Every time they dump paper silver to suppress the price, it actually increases the physical demand because it makes the metal even cheaper for industrial buyers. They're essentially subsidizing the destruction of their own vaults. If you look at the COT report right now, you can see the tension rising. The managed money, the hedge funds, are moving into massive long positions, while the banks are scrambling to cover their shorts. The spring is being coiled tighter and tighter. The paper matrix is a powerful weapon, but it has one fatal flaw. It cannot manufacture a single atom of silver. You can create 1 billion digital contracts, but you can't use them to build an EV battery, a solar panel, or a high-end AI chip. Industry needs the atoms, not the pixels. So we're approaching a moment of truth, a point where the paper price and the physical reality can no longer coexist.
What happens when the short squeeze of the century meets a vault that is functionally empty? That's the break point, and that's what we're going to analyze in the next section. Because when this matrix shatters, the move won't be a gradual climb, it will be a vertical jump. Stay tuned, because I'm going to show you exactly how to recognize the signal that the game is over. So, we've exposed the empty vaults and we've unmasked the digital paper matrix. Now, the only question that matters for your portfolio is, when does it all snap? Every manipulation in history has an expiration date, and for silver, we're rapidly approaching the break point. This isn't just about a chart pattern, it's about a collision between high-tech reality and old-world finance. You see, the paper matrix relies on the assumption that silver is just a shiny luxury, but in 2026, silver is the oxygen of the digital revolution. From the silver-coated connectors in H100 AI chips to the massive silver paste requirements in next-gen solar cells, the industrial world is screaming for physical delivery. You can't build a semiconductor with a futures contract. You need the atoms. When these industrial giants realize that the COMEX registered stocks are too low to guarantee their production lines, they won't care about the spot price on a screen. They will bid whatever it takes to secure physical supply.
That is the moment the paper matrix shatters. When the industrial bid meets the short squeeze, the price won't just rise, it will gap up so fast that most retail traders will be left watching from the sidelines. But how do you handle the boring periods before that explosion? How do you maintain diamond hands when the big banks are doing everything they can to shake you out? The secret isn't staring at the silver price all day. It's watching the gold to silver ratio. Historically, this ratio is the ultimate BS detector for the precious metals market. Throughout history, the ratio has averaged around 15:1 to 50:1. Right now, as we sit in April 2026, we are seeing ratios hovering near 80:1. What does that tell us? It tells us that relative to gold, silver is currently one of the most undervalued assets on the planet. Whenever the ratio gets this stretched, history shows it eventually snaps back violently. In a true bull market, silver always outperforms gold to close that gap. If gold stays at current levels and the ratio simply returns to its modest 50:1 average, silver has to rocket higher just to catch up. This ratio is your margin of safety. It tells you that even if the manipulation continues for a few more months, you are buying silver at a deep historic discount compared to its yellow brother. This is the diamond hands strategy. You stop measuring your wealth in dollars, which are being printed into oblivion, and you start measuring it in ounces and ratios. The big banks want you to get frustrated. They want you to see the price go sideways for weeks so you'll sell your boring silver and chase the next meme coin or overhyped tech stock. They want your physical ounces so they can cover their own massive short positions before the vaults hit zero. Don't give them that satisfaction. Understand that the current sideways price action is an accumulation zone. Every day the price stays suppressed while the warehouse stocks drop is another day the coiled spring gets tighter. Your goal isn't to day trade this, it's to position yourself before the exit door gets too crowded. Look at the data from the Silver Institute. We are in the 5th year of a structural deficit. Look at the COMEX. We are at 50-year lows in available supply. These are the real signals. The price on your app is just the noise they use to distract you. But look, I'm not just here to tell you it's going up. I want you to be prepared for the final shakeout. Usually, right before a massive breakout, the manipulators take one last desperate swing to drop the price and trigger a wave of panic selling. It's the darkest hour before the dawn. If you see a sudden, unexplained flash crash in the coming weeks, don't panic. Check the vaults. Check the industrial demand. If those haven't changed, the crash is a gift.
We've covered the why, the how, and the when. Now, let's bring it all together. In the final part of this video, I'm going to give you my specific outlook for the rest of 2026 and the one question you need to ask yourself before you place your next trade. Stay with me for the closing thoughts. We've pulled the curtain on the COMEX, we've unmasked the paper-silver matrix, and we've identified the breakpoint where industrial demand meets a historic supply crunch. The conclusion is inescapable. The price you see on your screen right now is a temporary illusion, but the physical scarcity we've discussed is permanent. The paper matrix is losing its grip. As the vaults hit 50-year lows and the gold-to-silver ratio remains at historic extremes, the window for this bargain of a lifetime is closing. Remember, the big banks aren't suppressing the price because they think silver is worthless. They're doing it because they know exactly how valuable those remaining physical ounces are. They want your patience to run out before their inventory does. Don't let the daily noise distract you from the structural reality. The real bull market doesn't start when the price hits a new high. It starts when the paper promise can no longer cover the physical truth. We are standing at the edge of that transition right now. So I have one final question for you. If the COMEX announced tomorrow that they were officially out of silver for delivery, would you rather be holding a digital contract or a physical bar? If you believe in the power of real assets, drop a comment with the word physical below. Let's see who's playing the long game. If you found value in this deep dive, hit that like button and subscribe to stay ahead of the next market explosion. The vault is draining. The spring is coiled. I'll see you in the next update.